Today we're diving into Sanofi, currently trading at around 82 euros with analysts targeting around 96, implying roughly 70% upside in 1 year. With earnings just a few days away, now is a good time to take a closer look at both the valuation and a deeper breakdown of what the company actually does. At first glance, this looks like a company with strong fundamentals, but a weak stock price. In 2025, revenue grew at about 5.5%, reaching 46.7 billion. In the latest earnings report, Sanofi also beat expectations, coming in at 91 cents per share versus the expected 85 cents. Despite that, the stock is still near its 52 weeks low of 74. It also offers a 5% dividend yield, trades at PE of around 20 and has a market cap of roughly 98 billion. Another interesting thing to note is that Sanofi has been trading between mid-60s and around 100 euros over the past 10 years or so. One positive from this trend is that lows are gradually getting higher over the last years, which could suggest some underlying strength building up in the company. It will be important to watch whether the stock can finally break above this long-term resistance level, and if it does, it could potentially set up a breakout. Another point I want to highlight is that Sanofi, as a French company, is also listed in the US under the ticker symbol SNY. It trades as an ADR, which means one ADR doesn't represent a one-to-one share of the company. Instead, you need 2 shares of SNY to equal 1 share of Sanofi on the French exchange. Now let's talk about Sanofi business segments. The company operates in 2 main divisions, the largest by far being pharmaceuticals, which makes up about 82% of revenue, or roughly 35.8 billion in 2025. These segments includes areas like immunology, rare diseases, oncology, and so on. And key driver growth here is Dupixent, which brought in about 15.17 billion in 2025 alone, representing 21% growth year over year. The second segment is vaccines, which represent around 18% of revenue, or about 7.9 billion. The best vaccine Beyfortus grew 9.5% last year and brought in 1.8 billion. Sanofi also completed a 50% sale of its consumer health business, Opella, in 2025 for about 10 billion euros. Overall, Sanofi is now positioned as a more focused, pure-play biopharmaceutical company. Now let's talk about which products actually brings money in Sanofi. There are a few key products worth highlighting. We already mentioned blockbusters of Dupixent and Beyfortus, but we also have Lantus and Toujeo in diabetes, which brought in about 1.7 and 1.3 billion respectively, and both are still growing at double-digit rates. Another product that is bringing over 1 billion in revenue is Fiberzyme in rare diseases sector. On the other hand, we have Aubagio, which is down about 35% year over year, which is expected since the patent has expired and the product is now in the decline. The biggest driver by far, as we can see, is Dupixent, which is projected to reach over 22 billion in annual global sales by 2030. Overall, Sanofi has more than 60 products under its umbrella, split as 43 are found in the medicine division and about 16 in vaccine division, but most of the revenue is still concentrated in a key few drugs, with Dupixent alone accounting for about 36% of total company revenue. Now let's talk about what's coming next in Sanofi's pipeline. The company has more than 80 drugs and additional expansion in development. One of the most important is amlitelimab, which could potentially bring in around 5 billion in peak annual sales. If successful, it could become the second largest drug in Sanofi's portfolio after Dupixent. It's currently in phase 3 trials and a regulatory decision could come around in 2026. Next one is Dupixent expansion that received approval back in February. This adds another layer of growth potential for Dupixent to reach those 22 billion we talked earlier. We also have lunsekimig for asthma, which is currently in phase 2 trial. This drug could reach up to 3 billion in annual sales if successful. We also have a drug in multiple sclerosis, which is also being tested in phase 3. Although results in PPMS were not successful, yet it might make up to 4 billion in peak annual sales. And finally, there's another compound for inflammatory bowel disease showing strong phase 2 results. This drug could potentially reach up to 6 billion in peak sales. Overall, Sanofi pipeline could generate around 18 billion in peak sales if everything is approved. However, amlitelimab is the most important near-term catalyst and could potentially become the next blockbuster after Dupixent. Now, before we move into valuation, let's look at management guidance for this year. They are guiding for high single-digit growth, and they are also continuing to return capital to shareholders through share buybacks of around 1 billion in 2026. The company has also increased its dividend to 4.12 euros. Looking ahead, they're also awaiting key pipeline catalysts we just mentioned. EPS growth is expected to be slightly faster than sales growth, and on the risk side, the main concern are tariffs, especially from the US. Since Sanofi's European pharma company exporting to the US, tariffs of up to 15% could be a headwind, and most of its manufacturing is based in France and Germany. US represents around 50% of all the Sanofi revenue, so this is very important. The next major catalyst in the near term is earnings call on 23rd of April. And now let's see how much should you pay for the stock. We're looking at 3 different revenue scenarios. In the bear case, we are projecting 3% of annual growth rate over the next 3 years. This assumes pressure from pricing, potential regulatory delays, and slower than expected expansion into new indications. For the base case, we are using 4.5% growth. This lines up with Sanofi average growth over the last 5 years. And in the bull case, we are assuming 6% growth. That would happen if new drugs perform well, and major risks like tariffs don't materialize as strongly as feared, so without price pressures. And as mentioned, management is guiding somewhere around the bull case. Next, let's look at margins across 3 scenarios. In the bear case, I'm using EBITDA margin of 25% with cash flow from operations at 18.8%. For the base case, EBITDA margins comes in at 26.5%, while cash flow from operations is just shy of 20. And for the bull case, EBITDA margins improves to 28, with cash flow from operation being at 21. To put this into context, the long-term average over the last 15 years are higher, around 28.7% for EBITDA and 22.7% for cash flow from operations. And I'm intentionally being conservative here. The reason is, as we saw before, the stock hasn't moved much over the past decade, and there are risks of margin squeeze because of tariffs. For cash flow, I base the assumptions on the historical relationships to EBITDA over the last 15 years. And this is how I got the numbers we can see here on the screen. And for capex, I use a slightly higher than average assumption of about 5% of revenue. Again, just to stay on the conservative side. And here is the relationship I was referring to between EBITDA in blue and cash flow from operations in red. From this, what we can see that both are growing at a similar rate and moving in the same direction, which is exactly what we want to see. It suggests that the earnings are being supported by real cash flow. This now leads us into free cash flow estimates for 2028. What this shows is simply the impact of revenue growth and margins we looked at previously, with lower growth and margins bringing us closer to 7 billion in free cash flow, while stronger performance on both drive cash flow up towards 9 billion, with all the rest being in between. To make this more practical, we can translate this free cash flow estimate into a stock price using perpetual growth rate model. We assume discount rate of 10% and a 2.5 perpetual growth rate. Based on this, the valuation ranges from about 70 euros on the lowest assumption all the way up to 90 euros on the highest end. What this tells us is pretty interesting. Even under our more conservative assumptions with modest revenue growth rate, but with margin expansion, the stock starts to look attractive at current levels. That said, this doesn't include a strong margin of safety beyond the conservative assumptions we used. On the flip side, even if we assume highest revenue growth, if margins stay at current levels, the valuation only comes to around 76. So, growth alone isn't enough. Margin improvement really matters here. We can see a similar picture when we look at analyst estimates. Using their free cash flow numbers in the same model, we get a valuation closer to 110. And this creates a bit of a disconnect. The model suggests that the stock could be a clear buy today, while the average one-year analyst price target sits at around 96, with highest assumption being at 112. But again, our model is based on today's price, while analysts are expecting this price in 1 year. So overall, the valuation leans positive, but it really depends on whether margins improve from here. But let's look at EBITDA valuation to see if we get a similar story. Starting off, what we can see is that Sanofi is currently trading at multiple that it's about 32% below the industry average. In a bull scenario, that opens the door for multiple expansion, which would support higher valuation outcomes. This is reflected here in the upside case on the right. On the other hand, the fact that the stock is already trading at a discount also provides some margin of safety or downside protection. If the bear case plays out, a lot of that risk may already be priced in, so the downside could be more limited. But even with those numbers in red, we are where the stock currently sits. What's also interesting is that with analysts' numbers, we get even higher assumptions, both for industry and for company averages, sitting above our model range. So the question is, if analysts are this optimistic, if we put their EBITDA and free cash flow numbers into our model, why aren't they projecting high returns? Well, it likely comes down to what we discussed earlier. The stock has been range bound for the past decade, and that seems to be keeping expectations more conservative, despite their underlying fundamentals. But that is just my guess. Let me know in the comments if you believe I'm wrong. Now, before the final verdict, I want to highlight what could make my model wrong. The first and most important risk is concentration. Around 36% of revenue comes from a single drug. That means if there is any clinical setbacks, pricing pressure, or competitive threats to this product, the entire business could be significantly impacted. Even though there is some protection through other drugs, this concentration risk is still very high. So it's something to closely monitor, especially as we get closer to potential patent expiry or increased competition. If no new drugs successfully replace that revenue stream, it becomes a real concern for holding the stock long term. But Dupixent is patented for another 10 years, so Sanofi has time to find another blockbuster. The second is what we already mentioned, tariffs. There is a potential, or now a reality, of 15% tariffs on European pharmaceutical imports into US, which could pressure margins since a large part of manufacturing is based in France and Germany. I already mentioned that 50% of all the revenue is made in US. The third risk is pipeline risk. We have already seen one indication of a drug fail, which shows that not everything in the pipeline will succeed. While this isn't unusual in pharma, additional failures could hurt revenue and investor confidence, as more drugs move through clinical trials. The fourth risk is more structural. Some older drugs like Aubagio are already declining, down about 35% last year, and other legacy products are also fading. This means future growth has to come entirely from new launches, which is expected in pharma, but still creates execution risk. Now, based on the three scenarios and applying a 10% margin of safety, the Sanofi price-wise falls into our base case. I don't think both multiple and margin expansion are really on the table right now, especially with the uncertainty regarding tariffs. Even though Sanofi is a strong company, that kind of upside doesn't look very likely in the short term. So I'm rather cautious, especially with earnings around the corner. The guidance on tariffs, margins and revenue could be a decisive moment where the stock will move. For now, our base case values the company somewhere between 71 and 91. So if the stock drops below 80 post earnings, I would look at this company again to see management guidance and whether margins are holding up or improving, and whether set conditions could support a future re-rating, and that would push us into like industry averages. If that happens down the line, we could eventually see the stock move into 90s or even 100 years range. Given its history of trading in a range and the existence of other opportunities like Novo Nordisk or Adobe, the real question is whether this is the best allocation of capital. Let me know in the comments below if you agree. If you find this video useful, consider liking and subscribing, as it really helps. Thank you so much for watching, and I'll see you in the next video.